Hey everybody, so this video is a continuation on my Facebook group post about credit scores not being the only thing that impacts mortgage rates. There's actually 9 to 11 things that impacts rates. So I created a video about that. So if you haven't checked it out, check out that video on what impacts mortgage rates. Now in that Facebook group post, a lot of folks were commenting about if DTI impacts rates or not, which I responded to in a video as well. But then they are also asking, how do you calculate DTI and some other math formulas that goes into mortgage lending? So today I'm going to be sharing with you the 3 most important math formulas that you need to understand when you're going through the mortgage process. So don't be alarmed when I said math formulas. It's not calculus or some complex statistical formulas. This is just simple, basic arithmetic. So I'm going to walk you through it one by one. So we're going to take a look at Lewis and Clark's scenario as I walk you through these math formulas. So when we take a look here, they have a purchase price of $350,000, down payment of $70,000, loan amount of $280,000. Credit score we're not going to be concerned by because none of the math formulas I'm going to be sharing with you today includes that. So the first one is going to be loan to value ratio. The loan to value ratio for a lender is important because it calculates risk. And what I mean by risk is the risk for a default or foreclosure. So the lender is always going to try to calculate the risk of, is the mortgage loan going to go into default? Is the mortgage loan possibly going to go into foreclosure? Now, this is all based on a bunch of data points where they came up with, what's a risky loan to value ratio versus what's not a risky loan to value ratio. So the lower the loan to value ratio, the less risky, and the higher the loan to value ratio, the higher in risk. And that's where the rates are going to be fluctuating. Now, if we look at how to calculate the loan to value ratio, let's take a look at what the value is here. The value is $350,000 for the loan for the value of the home. The loan amount is $280,000. So it's a simple math of $280,000 divided by $350,000. So if we pull up the calculator, let's do that together. 280 divided by 350, and we get 80%. Now you can look at this in reverse, which is how much down payment you bring to the table. If you bring 3% down payment, that means your loan to value ratio is going to be 97%. If you bring 5% in down payment, that means your loan to value ratio is going to be 95%. And again, if you bring 10% in down payment, that means your loan to value ratio is going to be 90%. Now, the other math formula that I find my clients calculate incorrectly often is monthly gross income. Now, we use monthly gross income when we're calculating our ratios. We don't use net income. A lot of our clients ask us, why isn't that not net income? Because I get taxed and the only money I can use is the net income. I don't make up the rules. The conventional loans and the way mortgage lending works, the ratios is based on gross income. So here are 3 ways that typically clients are going to be receiving income through their pay stubs, either weekly, bi-weekly, or semi-monthly is how they're going to be getting paid. Now, if it's weekly, let's take a look here in this example. This person is getting paid $1,700 a week. There's 52 weeks in a year, so we got to calculate the annual gross income and then divide that by 12. So 1,700 times 52 weeks, this person makes $88,400, divide that by 12, and the gross income or gross monthly income is $73.66 and 67 cents. Now let's take a look at the next example, which is bi-weekly, which means you're getting paid every other week. Okay, which is different from semi-monthly, and we'll get there. So bi-weekly, this person's getting paid $28.50. There's 26 bi-weeks, right? Because it's 52 weeks, divide that by 2 is 26. So what was this person getting paid again? It's $28.50. So $28.50, let's calculate the annual gross income first, times 26, and divide that by 12 is $61.75 gross monthly income. Now the last one is semi-monthly. A lot of folks get semi-monthly and bi-weekly confused. Just remember, bi-weekly is you're getting paid every other week. Semi-monthly means you're getting paid in the middle of the month and at the end of the month. So the 15th and at the end of the month. Now, semi-monthly, this person's getting paid $37.25. Semi means twice a month, so it's going to be 24. So $37.25 times 24 is $89,400. You divide that by 12 months. And this person's gross monthly income is $74.50. Now, calculating the gross monthly income is important because it goes into how to calculate DTI or debt to income ratio. Again, DTI, this ratio is important because it's calculating and assessing risk. Is there a high risk, low risk? Now, currently, there's no scaling in risk levels based on DTI. It's just, do you qualify? Do you not qualify? Whereas for a loan to value ratio, it does scale and your rate gets impacted through that scaling system. Now, I'll share that with you at a different video. That's a really long video. So if we focus back on the debt to income ratio, there's two types of debt to income ratio. One is the housing ratio, or what we call the front end ratio. And then the second one is going to be your total DTI or your back end DTI. Now that's going to include your housing plus your other monthly expenses, which can be your student loans, your car loans, your credit card payments, or other monthly expenses that you have. Now it's not going to include your groceries or your gas bills or any of that sort, or your utilities, just those monthly recurring ones that's coming along. So if we take a look here, the gross monthly income for this individual is going to be $6,000. The mortgage payment that this person has, which is going to include the PITI, principal insurance tax and or PITO is principal interest tax and insurance, is going to be $2,100. So $2,100, divide that by 6,000. This person's front end DTI or housing ratio is going to be 35%. Now, if we take a look at the other expenses they have $700 of student loans and car payments. And so we're going to add 2,100 to the 700 or vice versa. So 2,100 plus 700, which is 2,800. You divide that by their gross monthly income of 6,000, and their back-end DTI is going to be 46.67. Now, what do we look at? We look at the back-end DTI for a conventional or FHA loan, which is going to be 46.67. There's going to be certain circumstances where we're going to be looking at the front end, but most of the time, I want you to focus on the back-end DTI. As long as for a conventional loan, it's under 50%, you should be good. And then for an FHA, depending on the down payment, it's going to be ranging from 57% all the way down. Okay, so I want you to focus on that. Now, the last thing that a lot of clients are asking me is, what is a good DTI ratio? So the total DTI or the back-end DTI ratio, I can't comment on that only because it's either you qualify or you don't. And there's no real, what's a good number, because a lot of folks, your expenses are going to be different. Some folks have a lot of car loans, some don't. Some is paid in cash, some do use a car loan. Some have student loans, some don't. So it's hard to say. But on the housing expense, I want everybody to focus on 25 to 28%. That's where you should be targeting, because then based on your net income, it's going to be right around the 35% mark. Now, if you found this video helpful, you should check out my video on what about your loan application impacts rates. Hope you enjoyed this video. If you did, please like, subscribe, and comment below. Appreciate you, and talk to you soon.